Call this Revenue Committee meeting to order. Donna, will you call the roll?
Roll call for Senate Revenues, Senator Case.
Present.
Senator French,
Excuse me, here.
Senator Ide,
Here.
Senator Pappas.
Here.
Chairman McEwen.
Here.
All present, Mr. Chairman.
First order of business is House Bill 282. Representative Locke.
Thank you, Mr. Chairman and committee, and thank you for this opportunity to present this bill. I really appreciate this. And I just wanted to start off and maybe just give a little bit of kind of why this bill. And I wanted to throw out a few things that to just discuss that initially. So as you all know, we've kind of had this process we've been working through and using for property taxes for a fairly long time, where fair market value is calculated every year. And what has happened, a lot of people say, hey, it's a great process, and it has been at some level, but more recently what we've seen is it's susceptible to this spike process that we saw with the COVID bubble. And what we really start to realize is as we continue with this fair market value process, we continue to tax unrealized capital gains. And so I bring this bill before you, and I won't get into a lot of detail on opinions and a lot of the other things, that are happening out there, but I brought this concept of acquisition value. And what is acquisition value? Well, my view of acquisition value is this is fair market value at time of purchase, is basically what we're going to be talking about here today. But of course, as with anything, with change comes a process that takes some work. And so that's what I'm going to describe to you today and what I've tried to do with this bill. And I think we've done a pretty good job with a lot of smart people putting their efforts into this. We've tried to take a good approach to a transition to what I believe is a better approach for us, where we're getting back to what do you pay for your house? You pay based on your acquisition value moving forward. So moving on, and I wanted to give a quick summary of what the bill does, because that might be a little bit easier if I do that up front. So kind of some of the initial things. First of all, it's the attempt with this bill right now is to apply only to the new fourth category. So we're talking about residential real property is the category that this bill applies to. Second that you'll see in this bill is the concept of a rollback to the pre-COVID. Now, I'll explain that in a little bit more detail as we go, but you'll see built into the bill is taking us back to 2019, for lack of a better term, resetting our baseline and then moving us forward. Now, what it doesn't do is it doesn't take everybody back to the 2019 price. And the reason it doesn't do that, because built into the bill is the concept of an escalator of sorts. So I felt like that having it might be appropriate to have an escalator, whether it's, I put a 2% or CPI-based escalator in there, whichever is lower, to basically say, hey, yes, we do see increases in prices, and so I put an escalator in there, but ultimately it keeps that price down in a reasonable range. And let me explain why I picked a lower number. I picked 2%. Let me just use an example of 5%. I always like to throw this example out because it puts things in perspective. So I always try to remind people that if your property tax only goes up 5% a year, that means your property taxes double every 14.4, 14.5 years. So by the time you hit 29 years, you've quadrupled your property tax. And the next question you have to ask yourself is, do you own your property? So that's why I use a fairly low escalator in there. I wanted to at least make that clear. And then what this bill does is it takes us to what, again, you'll see acquisition value used in here, but then in 2026, what it does, so between 2019 and 2020, there's a process, and I'll walk you through that. But in 2026, it takes us to your acquisition values. Now you're going to be charged tax based on what you paid for your home, rather than a fair market value calculation that's out there against what everybody else paid for their home. So that's the concept of the bill overall. I do want to walk you through a kind of a phase-in of this, and what I tried to do, and the reason I'm going to bring up this phase-in, and this will make the walk through the bill clear. So I'm sorry I'm taking a moment here to help make this simpler. But I kind of have this phased approach, and this was the approach I took with this rollback and getting us to an acquisition value. So kind of the phase one is everything that was purchased on or before 2019. And after a lot of analysis, there was a lot of discussion on the best approach to take. And what I thought was probably an unreasonable burden on all parties involved, your assessors, the state, and everybody, was how do we go back and figure out acquisition value for all of these houses in 2019? I did not believe that was a practical implementation of us migrating to acquisition value. So what you'll see in what I'll refer to as phase one and phase two, phase one being 2019 or before, the objective is to take everybody back to the fair market value calculation at 2019. So if you bought it before or during 2019, your house would go back to that 2019 value. And then the escalation process, the escalator would be applied based on if we saw increases in our numbers. Then the second phase of this is what happens between 2020 and 2025. So you'll see this second phase, and when I get into the bill, you'll see this kind of comes out in the bill, but I thought it would be better for me to explain this way. This phase two, so if you bought it in 2020 or 2021, what would happen? We would use the fair market value calculations in those years. So in 2020, if you bought it in 2020, you'd use fair market value calculation of what your property was worth at the beginning of 2020, and that would be the baseline. And then moving forward to the current date, the escalator would be applied. Maybe it's 2%, maybe it's CPI, which maybe it's 0 or 1 or whatever it is based on CPI. But that's what happens in this phase two. And then finally, what we would actually implement is beginning in 2026, the goal is to start to implement. Now when you purchase your house, you go through the normal process, go through the title company. I know all houses don't, but now, okay, I bought my house for $300,000. Now my tax baseline is based on that taxation, what I paid for my house. So that's 2026, that's kind of that third phase. Moving forward, we started implementing acquisition value. So hopefully that describes, that's the bulk of the bill. There's some other concepts that I'll hit in the bill. For example, there are some one-off cases that kind of require, there's some one-off cases where it would require, depending on a house, somebody comes in and says, hey, I paid $5. There was never the intent with this bill to make it to where you could pay $5 and that's your new acquisition value. That's not the intent. So what I've built into this bill is some capabilities to say, if somebody comes in and says, hey, I bought this $500,000 house for $100,000, the assessment, there's a process that says, hey, the presumption of evidence says that's not accurate. And in those cases, fair market value has to be calculated for those. In a second scenario, and there's many scenarios under each one of these, the user just doesn't provide any information to the county on what they paid for it. Well, the county assessors are going to have to do fair market value calculations to set the baseline of those houses moving forward, and then they would move forward. So I tried to deal with a very, very broad range of cases that could occur in this process. And finally, you'll see, I'll get to some additional cases that I interpreted as, let's call them transfers. So you transfer your house to your wife, your kids, and so there are some transfer cases where the bill deals with those two. So we'll talk to that. Any questions on that summary? Is that clear? I'm sorry I'm going fast because I'm trying not to steal everyone's entire life.
So after 2026, Representative Locke, does the 2% increase keep continuing, or CPI later? I'm not sure if I heard how you deal with it once the true acquisition values are set in 2026. Is it froze there, or does it go up 2% a year?
Thank you, Mr. Chairman. And the escalator remains in place beyond 2026. So it starts at that beginning, but it stays in place even after the acquisition in the current bill.
Thank you. Senator French.
Thank you, Mr. Chairman. Representative, what about a trust? And you have your property in a trust, you and your spouse or whatever, and you both pass away and it moves on to your children or whoever you've named in your trust, how's that process work?
Thank you, Mr. Chairman, and thank you, Senator French. So I actually have some transfer cases. So I tried to put some of that guidance in here for the department to try to cover that. So you'll see as I go, when I start going through the bill, I will actually get to some of that in the process. And hopefully, I probably have not covered every single possible case, but I attempted to cover some of the main ones, such as that one, sir.
You have any
Okay.
questions?
So if the summary is hopefully clear a little bit, let me go ahead and walk through the bill. And again, thank you for this opportunity to go through the bill. So this is definitely, and let me just take a step back and say, in my opinion, what we've done with a lot of these exemptions, I consider all of these exemptions as short-term tax relief. I consider that the truth of what we've been doing with these exemptions. What I believe this is an attempt, is a move toward true tax reform moving forward. And that's what I tried to do with this bill, is come up with some tax reform. So beginning kind of on the first page, kind of that's all some of that initial information, but you're going to see there are some minor changes in several different statutes. A lot of this is just conforming language, and I'm going to go through kind of some of those different areas. You're going to see we're going to go through there, and you're going to say, well, what's that doing there? So we kind of had to cover some conforming language across a pretty broad range of statutes, and then you'll see some of them, most of them we'll get down into in more detail down there in 3911, and you'll see we'll get into some of those. But let me go through those kind of briefly. There are some changes in going to page 2. You'll see that 34-1S142. Most of this is some conforming language change, but what we thought we needed to do here is put some additional, one of the goals was to put some additional teeth into the process of making sure the proper data is being submitted and documented. Okay, and so what you'll see in that on page 2, there are some references to subsection J in those initial paragraphs, and we inserted an initial paragraph J to again try to put some additional teeth into this. But a part of this is also trying to make sure we're not trying to take this to, as most of you know, we're not a full disclosure state, and we're not trying to take this to full disclosure, but we wanted to make absolutely sure that this data was available from a disclosure perspective to all of the key people in this process: the assessors, the board, the county and state board of equalization, the department, everybody. So this was part of it, of us trying to make sure, even though we're a non-disclosure state, making sure all of the key people had the right data. So we inserted a paragraph here to try to strengthen this a little bit. Moving forward into kind of 3911-101, there are some impacts to some of the definitions that you'll see there. And when you flip it over to page 4, you'll see, and this is where you'll start to see references to the major new paragraph. So I know this is a lot of pages, but we'll be able to go through most of this conforming language section fairly quickly. On lines 4 through 6, you'll see we inserted a reference in there: fair market value for residential real property shall be determined as provided in 3913 103B. Let's see, 18, I think that is. But you'll see we go through and we add again conforming language in some other paragraphs. You'll see that in 11 through 13 and 15 through 20. Really, this is all just confirming language in this definition section. Again, if you kind of at the bottom of page 4, we go to 3911-102. And mostly in this section, you'll see this fairly simple statement or other, describe the system of establishing the fair market value or other value required by law. Now, this was put in there just to make sure we covered this process, but as I mentioned before, the fair market value, as we described, acquisition value really is fair market value, is designed in this bill to try to be fair market value at time of purchase. That was the goal we were attempting to achieve with this. But you'll see conforming language is on page 5. You'll see, one of the things you'll see on, at the top, if you get to page 6, so in the taxpayer, in 3911-109, one of the things that we put into this paragraph, this is a kind of a taxpayer remedy section, and we put a statement in there, the rebuttal presumption in favor of valuation assessed by the department shall not apply to the extent the rebuttal presumption conflicts with the rebuttal presumption of this new paragraph that we're going to get into down here. So we needed to make that clear in this section. Again, at the bottom in 3913-102, this is just conforming language through many of these different sections. And then when we get to the, kind of to the bottom of page 7, we get into this section where we've added some changes. Now, there's going to be some pages of performing language in section 3913-103, but ultimately this is where we'll finally get to really the meat of this bill. But let me, page 7, you'll see that some of that consistent forming language or other value required by law. You'll see some changes on pages 9, or excuse me, pages 8. Again, conforming language, some changes in there. You will notice that this, with the implementation of Amendment A, some of this will have to change to conform with the way Amendment A will be implemented here. Because in this particular case, we didn't attempt to implement Amendment A in here. It probably needed to be done separately and more cleanly. So you'll see in paragraph C, kind of on page 8, provided that the value of the residential real property be determined provided according to this new paragraph. I put that in there, but I do believe that some of the language in this bill would have to be modified once Amendment A was implemented. Again, flipping to page 9, most of this is just a very simple conforming language.
Real quick,
Sorry, yes, sir.
why did we even put 9.5% in it?
So 9.5% was what, sorry, Mr. Chairman. Sorry, 9.5% is what was there. All that we added to this was my language below that. And at one point, I had considered attempting to put the implementation of Amendment A into this bill, but pulling out that separate, so basically what Amendment A has done, and I think everybody in this committee is aware of this, what ultimately will happen with the implementation of Amendment A is it will pull residential real property out of that all other property category, right? And I had actually attempted to do that in a version of this, but what I realized was that probably needed to be put in place and implemented correctly. So what I did do was I just put this statement into this paragraph C. So everything you see before the 9, up to the, and after the 9.5% was already there. All you're seeing here is this statement, provided that the value of residential real property shall be determined as provided in this new paragraph that you'll see in this document. So that's where that's a little confusing, and I'm sorry about that, Mr. Chairman. That was, I kind of went through that process. Do I try to implement A in this? And it created a little confusion either way. Hopefully that explained that.
Thank you.
Thank you. So moving ahead on to page 9, this is all simple conforming language. You guys have seen this. It gets put into some of these different statements, and that is the case all the way through to through page 10. Through, you'll see conforming language down in the middle of the page on line 9. You'll see some of that, and then you'll start to see where the real meat of this bill. So now I'm going to walk you through, and you remember I described kind of the 3 phases and how this was implemented. I kind of described some of the one-off scenarios. That's what we're going to get into here. So let me begin at the bottom of page 10. Okay. And we're looking at a change here where this paragraph, so we're on 3913-109, and we're down there, and we've implemented paragraph 18 at the bottom, Romanet 18, and the following shall apply to the valuation of residential property as made subject to taxation in subparagraph 3C of this subsection. Now, beginning at the top of page 11, we get into the meat of the bill. So in paragraph A, so lines 2 through 4, you'll see beginning on January 26, 2026, the fair market value of your residential property shall be determined as follows. So getting down into the subparagraphs here, Roman numeral 1, 2, and 3, starting with 1, for the residential real property that last acquired on or before December 31st, 2019, the base value of the residential property shall be equal to the fair market value of the property on January 1, 2019. So that was that phase one I tried to describe in advance. Hopefully that makes some sense there and connects the dots a little bit. Now, Roman numeral 2, for any residential real property that was last acquired on or after January 1, 2020 through December 31st, 2025, the base value of the year will be the base value for the residential real property shall be equal to the fair market value of the property on January 1st of the year the property was last acquired. So that was that phase 2. So each year, so let's say you bought a house in 2021, your house would be priced at your the 2021 fair market value as its base year. If that makes sense. So that was that phase 2 component. And let me explain why I did that if I didn't do a good job of explaining that before. This concept of trying to go back and say, hey, based on the current system with the statement of consideration and the processes that are currently followed, how easy/difficult would it be to go back and figure out everybody's acquisition value? One of the reasons a lot of people have said, hey, we should go back to the original acquisition value, but you can all imagine how difficult that process would be. I attempted to make this transition period using common practices that the assessors, the Department of Revenue has put out there to make sure that us rebaselining this process allows us to put everything in a baseline and then begin us moving forward in this process. So again, there's some transition there. Now, finally, Roman numeral 3 at the bottom of page 11, for the residential real property that is acquired on or after January 1st of 2026, there shall be a rebuttal presumption that the acquisition value of the property, again, the fair market value of the property and the acquisition value shall be used as the fair market value. And really, again, I'm going back to a true acquisition price. Really, theoretically, that it's absolutely, if you look at the definition of fair market value, that's basically exactly how it's described. I probably have the exact verbiage here. This is I probably should have read this before, but fair market value means the amount of cash or terms reasonable equivalent to cash a well-informed buyer is justified in paying for a property and a well-informed seller is justified in accepting, assuming neither party to the transaction is acting under undue compulsion and assuming the property has been offered in the open market for a reasonable time. So that basically that's what acquisition value in 99% or 90% of your cases really should be, is exactly that. And that was, so you'll see that at the bottom of page 11, that was that transition to now moving to acquisition value moving forward. Okay? And that paragraph sort of ends at the bottom. So let me just capture the last. So I'm just going to read the very bottom of that paragraph on page 11 and move forward. Basically, I'll read the whole thing. For residential real property as acquired on or before on or after January 1st, 2026, there shall be a rebuttal presumption that the acquisition value of the property is the fair market value of the property, and the acquisition value shall be used as the base year value for the property, except as provided in subdivision Roman numeral 4 of this paragraph. Now, you'll remember I mentioned that there are some cases where, some one-off cases where what will be provided to the clerks and the assessors is not likely to be sufficient for them to know what the acquisition value is. And I think some of the language that you'll find in this bill when we get to the end is part of this process, the current statement of consideration process, absolutely needs to be bolstered and be improved to make sure that the proper data is in here, and we put in here, the department is going to have to promulgate some strong rules in this process. But this opens up this next paragraph Roman numeral 4 that you see on page 12, where notwithstanding subdivision 3 of this paragraph, for any residential property that is acquired on or after January 1st, 2026, the fair market value of the property on January 1st of the year of the property was acquired shall be used on the base year value of the property if, and here's our two cases that I described to you. The presumption under the subdivision 3 of this paragraph is rebutted by a preponderance of evidence showing the acquisition price paid to acquire the property was not fair market value because a party to the transaction was acting under undue influence, or the terms of the transaction were not negotiated at arm's length between the informed buyer and seller. So this is a process where some additional structure and rigor is going to have to be put into capturing the data and providing that data and it kind of gets provided through the clerks as part of the title process, but ultimately then to the local assessors. And this gives an opportunity. The intent of this bill, and this has been sold out there numerous times, the intent of this bill was never to say, hey, you can sell your house to your best bud for $5. That was not the intent. And we're attempting to capture these non-arm's length transactions in this process. So that was the first one, where the data provided was not sufficient. And number 2, at the bottom of page 12, is simply the owner of the residence. So when the data is provided to the clerks and the assessors, they don't provide any data. In
Take
these,
a breath. Senator French.
sorry.
Thank you,
Mr.
Mr.
Chairman.
Chairman. Yeah, before you go on, Representative Locke, a question for you. In a hot real estate market, I'll just use my county as an example, that acquired value, maybe they're willing to pay 30, 40, 50% more than, just to get the house, right? And then that equates into turns into fair market value, from what I understand. What does that do to when the assessor assesses everybody in the neighborhood for the next taxable year? Because I think they base it on like properties in the area. So suddenly you have this anomaly of, let's say this $400,000 home was suddenly, somebody was willing, because they're moving in, fogging into your area, willing to pay $600,000, $650,000, and suddenly that's, quote, the fair market value. What does that do to the others in that area with like property? Thank you.
Thank you, Mr. Chairman, and thank you, Senator French. And that's actually a very good question, because this absolutely affects that. So one of the reasons that I tried to push this acquisition value out to 2026, because that has actually already happened in many of our neighborhoods. This exact scenario that you just described has actually already happened. And this was one of the discussions. Do we want to, if we go back and that person said, well, gee whiz, if I had known it was fair market, that my acquisition price was going to be my fair market value forever, maybe I wouldn't have paid the extra $100,000. I don't know if that's a real scenario or not a real scenario, but that was part of the conversation moving forward. But let me explain how it affects us moving forward. If a person goes in and says, I'm willing to pay an extra 50% above or an extra $100,000, then for that person, they have chosen that, for lack of a better term, they have chosen that as their tax baseline moving forward. It's predictable at least. They know what they did. That was the agreement they made when they laid the money on the table. So that's what it does for that person. Now you say, what does it do to other neighborhoods or other houses in this neighborhood? Another great question, because part of this process is rebaselining these houses, right? So if you had bought your house in 2019 or in 2010, your house would have been rebaselined, and moving forward, your tax increases if inflation continues up and your house continues up, it's predictable. It's covered in that escalator cap of 2% or CPI, whichever's less. So it's at least predictable. That will not affect that other house until that other house sells. And then that other house, and then when your house, if you sell your house to the next buyer, then the next buyer may be affected by what the market value is, but they will, of course, then be affected by their acquisition value. Did I explain that okay? Was that clear enough? So it doesn't year by year, if a person comes in and spends an extra $100,000 or $200,000 in a house, that doesn't magically increase everyone's taxes in your neighborhood in the way that it's currently having that impact. But it will over time, if that happens in a neighborhood, it certainly will change what the next person buying a house in that neighborhood, how they're impacted. Certainly will affect that.
Okay, follow up, Mr. Chairman?
Go ahead.
Thank you, Mr. Chairman. This is on the subject, but not what we were just talking about. I haven't seen so far, and maybe it's in here and I missed it, the associated, say you're out in the rural and on a 5-acre lot, that associated land with that house, that real property. I mean, is that included in all this?
Thank you, Mr. Chairman.
Go ahead.
Thank you, Senator. Yes, you're going to see a paragraph, and I'm actually going to propose an amendment, which hopefully I've handed out, and hopefully I have a copy of my own amendment. I might have misplaced that, but we'll see that. But yes, that is covered in here, and that will be explained in here as well. And I am actually going to recommend an amendment to this committee if it moves forward that would make it more consistent with the way that has been worded in several other cases. I wanted to make sure we were consistent there, but absolutely, sir. Other questions? Okay, thank you. And maybe I will try to slow down. If I'm going too fast, just give me the slow down. I know this feels like a long bill, but I just wanted to.
We need to get through it in the next couple minutes, please.
I'll hurry as fast as I can then.
Okay, thank you.
Thank you, Mr. Chairman. So moving forward, you guys saw that at the bottom of page 12, we went through that. That was the second case that we discussed where fair market value would be used if a person didn't provide data. On page 13, paragraph B, the base year value determined under subparagraph A of this paragraph shall be adjusted as follows. So what you'll see when you get into Roman numeral I down there, it talks about the base year and the adjustment using the 2% and the CPI escalator. That's in Roman numeral 1 there. And let's see here, looking at paragraph Roman numeral 2 is added in there as well. In Roman numeral 2, and I won't get into a lot of detail because it sounds like I need to move this forward as quick as I can, but Roman numeral 2 at the bottom of page 13 provides some criteria in there for how, if you went in and you significantly changed your house, you added on an additional half of a house. We kind of cover that in page 13 and 14. I won't torture this committee with the details unless you want it. And that sort of rolls down to page 15, where we get to some additional information here. And in paragraph C, we talk a little bit about the amount determined pursuant to subparagraph A and B of this paragraph shall be fair market value of the residential property until ownership of the property is transferred. So that paragraph C is talked about this baseline, this property value will not change. The baseline value will not change until it's been transferred, until it's been sold to another person. Okay, so you'll see that in paragraph C. In D is where, as used in this paragraph, we talk about acquisition value definition. What I would propose to you, and I think hopefully was handed to you, I would propose some replacement language for Roman numeral 2 at the bottom of page 15. If as an amendment, I think that text needs to be replaced with the amendment that I have offered up, and hopefully you see that. And then I'll go fairly quickly through what you'll see on pages 16, and really we're just about done, so I'll hustle. You remember I discussed some of the transfer conditions. I know Senator, Mr. Chairman, Senator French had asked about those. I attempted to cover some of those. So transfer or acquisition of the residential property does not include, and so I provided some transfer cases, and I'll go fairly quickly. A transfer of property between spouses or between a parent and their child, a transfer of property pursuant a court order. Number 3, a transfer of property to a trust established for the benefit of the prior owner. Number 4, again, transfer of property to a corporation, partnership, or limited liability company if the prior owner of the property is a shareholder or owner of the corporation. So I tried to cover those. I included a donation of residential property to a religious or charitable organization or nonprofit organization. I kind of left paragraph 6 down there as a kind of an open ender. I probably missed some things. But at the end of the day, the intent of this transfer is that if you were to transfer this to your spouse, the point of this transfer is that it won't change in value. It won't go back to 0, and it won't change in value. The transferee will continue on with the same escalator that we were seeing in the previous. It will continue on as it was going previously. That's what the intent of the transfer section. And really, other than that, there's a minor conforming language change below that in 3913-109. And that is really the end of the bill. And it is a lot of pages, but ultimately fairly simple. And I stand for questions, and I know it took a little bit.
Senator Hyde.
Thank you, Mr. Chairman. Representative Locke, thanks for all the thorough examination of this and all the work you put into it. Just one real quick question. How do you dovetail acquisition value back to fair market value? Do you have an explanation on that? Thank you, Mr. Chairman.
Go ahead.
Thank you, Mr. Chairman. And so the way I connect acquisition value to fair market value, quite honestly, and again, this is my interpretation. As you guys all know, I read the fair market value definition. Well, a true arm's length transaction at acquisition time, at when you purchase your home, quite honestly, it is fair market value. That arm's length transaction, that normal arm's length transaction, which is going to be a very large percentage of the purchases, the sales that happen on a residential property around our state and everywhere else. But if you think about it, an arm's length transaction is exactly how fair market value is defined, is currently defined in our statute. That's how I connect the dots on those two.
I have one last quick question. We really don't have a good definition of a significant addition. So how and who decides what a significant addition is?
Thank you, Mr. Chairman, and I did go through that section very quickly. We attempted to put some sideboards on that. If you, and I won't steal too much of your life on that one, but we did attempt to, and I gotta get back to the right page. Let's see if here we go. Getting back to the right page, what I attempted to do is significant addition. We tried to put some sideboards on that as you kind of get down to the bottom where we talk about significant additions. We basically were trying to make it to where a significant addition, if you go in and you remodel your basement, you finish your basement or do those kinds of things, those are not considered significant additions. The intent and the language may not cover all the cases, but the ultimate goal of this, and this might be an area where some additional enhancement of the language here, or certainly some additional support, was that if you don't do a significant change to the footprint of the house, that's what would be considered in our attempt to word this. That was what was targeted as a significant change. I added on a third of the house.
Anything that adds habitable square feet.
That's what we were shooting for
Okay.
in that definition.
Any other questions? Department? Thank you, Representative Locke.
Good afternoon. Brenda Henson, Director of the Department of Revenue. Mr. Chairman, I really appreciate this opportunity to talk about House Bill 282, Property Tax Acquisition Value. This tax policy change is significant, 20 pages, and it warrants hours of testimony and fact-finding. Leadership assigned this bill to this committee yesterday. Here we are, Friday at 1:30, and we're talking about significant changes to Wyoming tax structure. But right now, the responsibility falls on the 5 of you to determine the fate of this bill. So what I have to say is thank you for running for elected office. Having been an elected official for 20 years, it is days like today that I am sure you ask yourself, why on earth did I run for elected office? It's your passion for public service. It's your willingness to step up for the people of Wyoming. Many of those people include multiple generations of family, friends that have been made friendships over the decades. But what's interesting is those are the exact people that this bill impacts. I've provided a handout. Don't get scared. I'm not going to go over all through those pages, but it is important information that you need to consider before you make this very, very important decision. So this bill is about changing the basis of tax for selected properties. It is not tax relief, and it should not be considered tax relief. This bill is not limited to altering the basis for taxation to acquisition value. As the good chairman reviewed, there's a lot more moving parts to this and a lot more triggers that if this happens, we pull this trigger and that's how we're going to value that property. And if this happens, we pull this trigger and that's how we're going to value this property. So when you look at the bill, page 11, line 6, looks at all those different ways. But what I would like to turn your attention to is the information that talks about, we know about these base years that we're going to talk about, but let's talk about acquisition value first. Let's go to page 19 or page 15, line 19. On that page, on line 15, it defines acquisition value. As used in this subparagraph means the actual full amount paid or to be paid to acquire residential real property. And then as the sponsor mentioned, we've got this definition of residential real property, which means, and I understand he's got an amendment, so I don't know what that says. But what's important to note is when you look at these two together, acquisition value paid. The good sponsor and I have had significant conversations about Does that include the realtor fee? Does that include, the insurance that I paid to verify that everything was working? We don't have, this is all we have for an acquisition value definition. So there's some challenge there. The other piece of this is line 15, page 15, line 19 defines residential real property. There is no guidance when there are outbuildings, additional acreage, etc. When you purchase a house, you go back and forth. The buyer and seller goes back and forth until you agree on a price. Okay? You don't say, I'll give you X for the house, I'll give you X for the land, that shed in the back, I'll give you X for that, that pole barn, I'm going to give you X for that. Think about an agricultural property that has dry crop and rangeland and a house, shed, some outbuildings. I'm going to pay a total price for that parcel. But this bill specifically talks about the acquisition value and how residential real property as defined in this bill has to be valued using acquisition value. But what do you do with all the other pieces that aren't included in this definition? Wyoming Constitution, Article 15, Section 1 states, all lands and improvements thereon shall be listed for assessment, valued for taxation, and assessed separately. We're not going to have that with an acquisition price. There's no mention in this bill about on those historical base years, how did that property exist in those base years? It doesn't talk about that. What if it changed? Residential properties change and structures are added, they're removed. Under the current constitutional and statutory laws, property is assessed and taxed as it exists on January 1 of each year to the owner of record. Changes in ownership, property characteristics, it's done constantly. That's what assessors do. The focus on the current system has always been accurate.
I
And I'm
have
gonna
a quick
demonstrate.
question.
Mhm.
Back to the constitutionality. I love it when us, not necessarily you, ma'am, are constitutional scholars, so hang in there with me. If the land and the buildings are included in the personal price, aren't they not being taxed according to the Constitution? They're in the total price.
Mr. Chairman, they are included in the total price, but the Constitution requires that for taxation, the assessor must value land and each improvement to that land, which is structures. They must be valued for taxation and assessed separately. That's why on your assessment schedule, you have a land valuation, you have an improvement valuation, and a total. The assessor currently, pursuant to the Constitution, will still have to do that unless the Constitution is changed. Thank you for the question. What I've
One
included,
quick follow-up. If in the sale of the property, the outbuildings and the land were broken out, then would you think it's constitutional?
perhaps, Mr. Chairman, and I would challenge anyone to think back when they purchased a property if they identified a different value for land and improvements. But thank you for the question. As I move forward, I want to turn your attention to the handout. These are some facts. These are just information for you. And if you'll turn to tab number 1, I've provided you with the total number of residential accounts in the CAMA system in each of the years 2019 through 2025. It's broken out by county. There are 10,500 more accounts this year than there were back in 2019. Another just proof that things change. And what are we going to do with all these properties? The next page is information related to new construction. The first box talks about structures on residential accounts built between 2020 and 2024. You can see that in 2020, we added 8,057 new structures. That includes residences and outbuildings on those residential parcels. And then you can see the numbers going further. And then you can see on the second box to the right, that just shows you how many new residences we had. Now, keep in mind, just because you have new construction and you've added buildings, doesn't mean they sold. You could have built those. There might not be a transaction that occurred. Now, when we look at this, the bill does say on page 14 that the Department of Revenue is going to adopt rules on how construction costs should be determined. Or the taxpayer can simply bring in their receipt for what it costs them. And we're to use that as a basis for taxation. Another little trigger that we've talked about. So what I've described is this process that county assessors are going to have to go through, keeping in mind we've got 230,000 properties statewide. And I'm going to cover some of the sales information. In 2023, we had 7,000 properties that sold, but I've got 230,000 to value with all these different triggers that I've got to figure out. That's what assessors have on their plate should this policy go into effect. Basically, they've got to figure out a base year, and then they've got to apply this 2% factor. And those have absolutely nothing to do with how the property exists on the assessment date. Let's talk about acquisition value. The next page in your packet, tab number 2, this is the current statement of consideration that when you purchase a property in Wyoming, you complete this. The page following are the instructions. So when a deed or a contract, another document is recorded in the county clerk's office, this statement has to be completed. And this is pursuant to 34-1-142. All the statute requires is that you provide the grantor, grantee, the date of the transfer, the date of the sale, a legal description of the property transferred, the actual full amount paid for the property, terms of the sale, the estimated value, and the value of non-real property. Let's say when I bought the house, I also got the washer, the dryer, the refrigerator. That's personal property. And so on the statement of consideration, it requires that you separate out that information. But this is the document that we get in Wyoming for sales information. And that document has rules associated, and the responsible entity for promulgating those rules is the State Board of Equalization. There's a penalty, you'll see it at the bottom of the second instruction page that talks about it is a misdemeanor to lie, to give false information on that document. But the other information that you need to know is when I deed a property, I can deed 6 different properties. Let's say I own some pasture land, I own my house, I own a townhouse, and I deed them all to someone else, to my children. I get one statement of consideration with that deed. I don't get a different statement of consideration for every property that was on that deed. So that's information that is important when you start looking at an acquisition value. The next document you'll see in your package is about 4 pages long. I took the liberty, we have one state in the nation that uses acquisition value. So this document is what's called a preliminary change of ownership report that's required in California. I'm just going to have you review that. The next documents that you'll see entitled California State Board of Equalization, there are about 7 pages of the other forms that property owners are required to complete in order to get the information that's necessary for the assessor to implement this acquisition value. The other item you'll see after that is a document that starts with Assessor Handbook, Section 401, Change in Ownership, again from California. Now, when included in your handout, I only gave you the table of contents. Why? Because that document is 170 pages long. This is the 170-page document in California that tells assessors when to use acquisition value. That's what we've got before us if we implement an acquisition value. I'm going to move on to sales information and how it's used in Wyoming currently. So for 2024 values, sales ratios, we had 7,041 valid open market sales statewide in Wyoming. That's about 3% of the residences in Wyoming. On January 1, 2024, the property had to exist in the exact same manner that it sold in 2023 in order for it to be considered in the statistical analysis. When you take all of those properties that sold in Wyoming, the median ratio was 95.30. Let me tell you what median ratio means. So the assessor has a value that they've determined. That divided by the sale price gives you a ratio. So here's an example. 375,000 assessor value, appraised value, divided by a $400,000 sale price equals a ratio of 93.75. Okay? What we do is assessors across the state are taking all of those and arraying them from lowest to highest. The median ratio, the midpoint, has to be between 95 and 105. Out of those 7,041 properties that sold in 2023, the median ratio statewide was 95.3. That means that half of those properties were above 95.3 and half of them were below. Using that uniform method of appraisal, 4,748 of those 7,000 properties were appraised by the assessor at less than what the reported sale price was. If this law were in place, 67% of those properties would have had a higher value under this system than our current system. I don't think that that's understood. The next piece that I want to discuss is just case law. Gray versus Wyoming State Board of Equalization, June 9th, 1995. The Supreme Court of Wyoming issued this decision. It is clear from the Constitution, and I'm reading from the decision, it is clear from the Constitution that the state of Wyoming and all of the relevant statutes and discrimination in a class is prohibited. Property must be uniformly valued and equally and uniformly taxed. The rules and regulations promulgated by the state board pursuant to the statutory authority authorize several methods of appraisal, which may be used by the assessor to provide uniformity. Reliance upon actual sale price in lieu of appraisal methods adopted by the state board may well lead to discrimination and lack of equality and uniformity. While one method of arriving at assessed value is a sale comparison approach, and it may rely on actual sales, it is not limited to the sale price for the particular property involved. We hold that the assessor, in that case, followed a valuation method properly adopted by the state board in this case. It was applied uniformly to all properties, sold and unsold, and like the district court, we do not perceive any arbitrary, capricious, or unlawful action by the assessor, nor is there an abuse of discretion. The focus of Gray's argument in this case was actual sale price should be used to establish fair market value. His contention was it's in accordance with the definition of fair market value, and the best and exclusive evidence of fair market value is the actual transaction price. The legislature and the State Board of Equalization diligently sought to establish equal and uniform methods for taxation of property in accordance with the Constitution. It would be a travesty to arbitrarily disregard that system in favor of utilization of a purchase price that would lead to wide disparity in the context of uniformity and equality. That is Supreme Court case law that is 30 years old and still applicable today. Our Constitution has not changed. Now, House Bill 82. It has a definition on page 3 and 4 defining fair market value for all property. Again, it hasn't changed. But what I want you to consider is that fair market value definition doesn't just apply to residential property in Wyoming. It applies to agricultural property, commercial property. Let me give you some numbers. We have 37,630 agricultural properties, and some of those have residents on them. We have 28,285 commercial properties, 1,648 industrial properties, 31,842 mobile homes. We have commercial and industrial personal property. We have the public utilities that the Department of Revenue values. We have mineral production in Wyoming. And what's the basis of the value for all of those? Fair market value as defined and still defined in this statute. One of the things to also note is assessors use the computer-assisted mass appraisal system to value all those properties that I just mentioned. What is a computer-assisted mass appraisal system? Mass appraisal. What this bill requires is not appraisal, and our CAMA system cannot administer what this bill's requests be done. So there will be significant programming. But what's important to note is we still need the CAMA system because we've got to value all these other properties using that methodology. Just going to touch briefly on two more things. Appeals. On page 3, tab 3 in your packet, there's a document. It's called County Assessor Property Profile. I would hope that each of you, and I hope every legislator in the state, goes to their county assessor's office and gets a copy of their property profile, because it will show you the calculations of how every acre of your land, how every structure on your property was valued based on the property characteristics on your property, not anybody else's, yours. This document, on the second page, it's page 2 of 10. Again, I mentioned that the Constitution requires that you break these values out. On this sample, you'll see a value for the single-family residential structure of $359,535, an equipment storage building, a farm utility loafing shed, and another equipment storage, a detached garage, a Quonset, each separate and identified. What also follows in this packet is all the characteristic information that your county assessor has gathered, along with a cost breakdown sheet. Dollar for dollar, you can see how your property was valued, along with your neighbors. It's all public information. If you believe that your property is exactly like the neighbor's property, go get a copy of the property profile. There are taxpayers in this state that request this on an annual basis. They want to see, even if their property characteristics haven't changed, what are the updated costs? What is the updated market value? And if they have changed, they can see, oh, I added a pole barn. $12,000. I understand. They have that data. That's transparency. Mr. Chairman, if I'm a taxpayer and I get an assessment schedule today, I look at it, I know that that's the estimated fair market value as of January 1 of this tax year. I can look at it, I can say, yeah, okay, I agree, I disagree. Now, how is that taxpayer going to know if they have been treated fairly? I acquired my property in 2021. I know the assessor's is required by this law to go back and use the 2021 appraised value. I don't even know what the characteristics were, nor does the assessor, because this law says you use 2021. It doesn't matter what it looks like in 2026. You use 2021, and then you're going to factor. You're going to apply this 2% or the consumer price index, whichever is lower. We're going to get to a value. That's what's going to be on your assessment schedule. Are you going to know if you've been treated fairly? Because this property profile that I just showed you isn't applicable anymore. Because the law says you just use this value that was a historic value and we factor it. That's your new value. And depending on when you bought it, your calculation's different. The next page is page 4. The only thing I gave this to you for is to recognize that's how historical sales information is housed in the CAMA system. That's all you've got. You've got book page, a date, the amount paid, and if you got financing information. That's all the historical information that a county assessor has as far as sales values right now. The last piece in your packet, I would be remiss. I mentioned that this bill would require hours and hours of testimony and fact-finding. Fortunate for you, that was done in 2023. In your packet, you will see the acquisition value study that was presented to the Revenue Committee on October 2nd, 2023. If you turn to page 6 of that study, you will see 8 items that were identified that have to be addressed before you can implement acquisition value. Now, keep in mind, this study is just looking at acquisition value. It didn't go into this situation of using past base years that were based on other things other than how the property exists today. This study just simply looked at acquisition value and all the challenges that exist. I'm not going to go through that study. You can read it, but it's important to note. Each of you, I'm closing here. I appreciate your patience. Each of you are a residential taxpayer. As a taxpayer, would you prefer a system where all property is appraised using accurate property characteristics, updated construction costs, depreciation and appreciation applied using industry-accepted appraisal methodology? Or do you want an assessment schedule that reflects a historic value factored? A property tax policy based on owner's circumstances is not fair, and it's certainly not constitutional. It is a tax policy that values property owned by young families buying their first home differently than property owned by someone who's been there for 10 years. So do you prefer to see the math that you will see in a property profile under our current system and know that you can get the math for any property in the state of Wyoming? Or are you satisfied with a historic value factored? As I began, I mentioned this bill changes the basis for property taxation. And anytime you change the basis for property taxation, you're going to have property owners that benefit, and you're going to have property owners that are harmed. I just encourage you, when you vote on this important policy, to recognize this 20-page bill impacts 230,000 property owners differently, simply based on circumstances. So with that, Mr. Chairman, I'm happy to answer questions, but I do know that there are several people in the audience that want to contribute and provide comment. So I will close with that, and I do appreciate your time.
Senator Ide.
Thank you, Mr. Chairman. Director, thanks for your thorough evaluation here too. But, you know, we're here just to point out, we have a policy back in Washington of monetary inflation, and price inflation is a symptom of that. And we're looking for a system to protect the taxpayers. I applaud the good representative for bringing this. I mean, we've got to look at a system that somebody doesn't get taxed out of their house. And, you know, he makes the point of unrealized capital gains. It's an unfair system with the policies we have going on in Washington. So I will leave it at that. We suffer the symptoms of that monetary inflation. That's the definition of inflation, is more money in the supply chasing a smaller amount of goods, and we're suffering those consequences. So we're searching for ways to not starve out the populace. Thank you.
So, Mr. Chairman, thank you for pointing that out, Senator Ide. This changes the basis for property taxation. It does not change the tax dollars. And so that's important to note. I mentioned that using this system compared to the system that we're on today would have been a tax bill increase if the level of assessment stays the same and the mill levy stays the same. The majority of the people that bought property in 2023 would have seen an increase in their property taxes based on what they purchased for the property. I would say to you that if you want tax relief, The other option is the constitutional option you have of reducing the level of assessment, which changes then what the mill levy is applied to. All the basis of tax is intended to do is identify, based on the property's value, how is that tax burden distributed? Acquisition value does not provide tax relief.
I agree with you. This bill's about tax reform, not tax relief.
Thank you, Mr. Chairman.
And-
And like I said, I know there are a lot of people that want to speak.
Having followed through 2 appeals in 2 separate counties, we can talk offline about that. But I'm going to tell you, I came out of those processes, nothing was equal and fair. It was such a Mickey Mouse mess, it wasn't even funny. And that's just my opinion, by the way. There was no constitutional thing or lawyers that joined in with me. That was just me watching it.
Well, thank you, Mr. Chairman. Yeah, again, as I stated, we all wonder sometimes why we run for public office, and I'm sure that there are assessors across the state that are wondering why. It was hard enough. I've worked in an assessor's office since 1988. I was there when we were on 25% of a 1967 replacement cost. I was there when we converted to fair market value. Being a county assessor is challenging, just as being a state legislator is very challenging. And I appreciate everyone who's willing to step up and serve.
I remind myself every day, this is a self-induced gunshot wound. So it's our faults for being here. And with that,
Thank you, Mr.
we'll move on. Senator Ide.
It's okay. I'm just, online, we have another agency, Chairman of the State Board of Equalization is online to provide testimony. I don't know about your intention about order. I'm just pointing that out.
My plan today is they're doing committee of the whole upstairs. I think it would behoove us just to get their testimony today.
Yeah, and I think he wishes to offer testimony, the State Chairman of the Board of Equalization.
We'll bring him in.
Okay.
I'm just saying we're probably gonna go past 1,400 hours. Let's bring in the State Board of Equalization. We'll get the agencies out of the way.
Good morning, members of the committee. Can you hear me?
Yes.
Oh, very good. Thank you so much for having me, and I apologize for not being there to testify. I testified on this bill on the House side, and I wasn't sure what was going to happen, and then I realized late that it was up today. My name is Marty Hartzog. I'm chairman of the Wyoming Board of Equalization. Jane Mockler, my co-board member, is out of the office, and Dave Delicath is tied up with some business here in the office. It's my pleasure to help you with this bill. I'm not going to parrot or review what Director Henson testified to. She covered the logistical problems of it well. I'm going to jump right to the constitutional part, which I think you've already alluded to, Mr. Chairman, and I agree with you. It's a difficult area to reconcile. Just to give you a sense, though, I've done extensive research on Article 15 of our Constitution, which are the tax provisions. I've looked at the convention debates, and I've also looked at what the state did in 1988 with respect to Article 15, Section 11, which addresses the provision that we have implicated. And just so you understand, in terms of the overall picture, the 30,000-foot view of constitutional property law, two features played almost above all others in Wyoming's tax world, dating back to 1889, September of 1889, and really through to the present. And the first one was full value. You'll find the word full value in Article 15, Section 11, Paragraph A. And it was something that was on the lips of every delegate to the Constitutional Convention back to 1889. And so when we talk about value and Wyoming's property tax system, understand that the concept of full value is in the Constitution. And whenever you do anything to change that, you're really inviting a problem and a challenge, which I think and I'm going to explain to you how this one does. And the second principle, and you can understand why, is uniformity of taxation and equal taxation. The discussions about Wyoming's property tax system were incredibly in depth in 1889. And the concept that every single delegate retreated to at the end of every statement was, at the end of the day, it better be uniform and equal. In fact, you can do a lot of different things. We can arrange to tax things differently, but everybody better pay the same. And that's one of the reasons the Board of Equalization, which incidentally existed as far back as 1869, found its way from territorial statehood to the Constitution and all the way to the present. The Wyoming Board of Equalization existed for the primary purpose of ensuring market value and uniform equal taxation. That was its core function and is today. Its role is in the Constitution. The board is established pursuant to Article 15, Section 10, and it says that the board shall equalize the values across the counties. So with that, I'm not going to belabor all that. I'm going to jump right into the two areas where this bill really causes a problem. And the first one, and I apologize in advance for saying it, I've never given testimony which was this strident or forward, and that is it's on its face unconstitutional in one respect. As I explained, the Board of Equalization's function dating back to 1869 was to ensure that all properties were valued uniformly. That's right there in the history, in the case law, and in the debates. Well, whoever put this bill together looked at the board's role and said, wow, if we do something like this, the uniformity is a problem. And so what the bill does is literally carve out the board's role from the tax system. Now, I don't know if there's an amendment that changes this, and it wouldn't fix it completely, but if you look at pages page 8 and 9, you'll see the board's statutory authority, which is 102.1. That is the lone statute which gives the board its function and lays out all of its roles. And you'll see that at the end of subparagraphs 2 and 3, paragraph 3, 2 and 3, you'll see that it says this paragraph shall not apply to residential real property taxable under, and then the statute, which is the new acquisition cost provision. So what this language is doing is simply saying, Board of Equalization, when it comes to this valuation methodology, you do not perform your statutory function, which is in effect the constitutional equalization role. And so that on its face, Mr. Chairman, members of the committee, is unconstitutional. And I hate to say it, but I think assuming the governor allowed and gave us the green light, we would literally have to sue the state on day one to prevent the statute from preventing our constitutional function. In other words, you're not permitted by statute to contravene a constitutional provision. And when you look at the board's role under the Constitution, it says we shall equalize values across the counties, equalize property values across the county. So that's on its face unconstitutional. And unfortunately, I think that would pit the Board of Equalization and possibly others against the state legislature. And what would happen is we would have to sue in district court, seek a declaratory judgment action to have the court look at what the statute does to interpret the statute and determine whether it is inconsistent with the Constitution. That's a serious problem. The second part is a more as applied. It's a little more nuanced, and there's been a lot of discussion in today's testimony about market value, whether an acquisition cost is fair market value. But a couple of things. An acquisition cost is not necessarily fair market value. It's evidence of market value, and we've addressed this many times. Director Henson testified and explained accurately what the Gray decision said. And in fact, it's been held across the country many times. The purchase price of a particular property is certainly evidence of that property's value, but it's not necessarily conclusive. And so the premise of this the law in creating what the legislature would define as market value is not quite correct. And along those lines, you have language in here that says properties will be taxed at fair market value or other value. Well, I would posit to you, members of the committee, you cannot simply say we're not going to stay with market value because the Constitution requires it, and we're going to opt for a different value. To the extent a different value does not align with market value, you've now again arguably run afoul of Article 15, Section 11 of the Constitution. But that's not even the worst part. And as Director Henson really fleshed out for you a little bit, we have a tremendous uniformity problem. If you go down the list on that provision in the Constitution, Article 15, Section 11, you get to subsection D, it says that taxation, not value, but taxation shall be equal and uniform. And then later in the provision, it says the legislature shall enact, and I'm paraphrasing, enact regulations to ensure uniformity and equal taxation. And so when we see the effect of an acquisition cost, what we see is a value that's locked in time with an escalator, but all around it are like properties being valued very differently. Now, the counter argument would be, well, if everybody's subject to this methodology, why isn't it uniform? It doesn't work that way. The property has to be valued based on its features, not based on when somebody purchased it or the circumstances surrounding somebody's acquisition. We have to look at what the property is, what it consists of, and then make sure that like properties are not treated disparately. And so that's another reason I believe that the Board of Equalization's role was peeled from the system, which is again unconstitutional on its face. What the drafters of this bill don't want is the board to do its job, because they know that when we perform our equalization analysis and we have a statistician, we have rules in place that govern all of this. And the chairman, you probably remember some of the discussions about the mass appraisal system in previous committee hearings. That's kind of what we're talking about here. But all of that regulatory law exists to look at all of the values in a group of properties across the county and between counties, and to ensure that they're all valued in a range tied to market value. If we have an acquisition cost approach, we now don't have uniformity fairly quickly. And here's the other problem. Even if you had uniformity between the properties where there was an acquisition cost, all of the other exceptions to the acquisition cost would then kick in, and you have market value assessed properties, acquisition cost assessed properties, a scatter chart of values all over the board. The board would necessarily be required to try to equalize, which would run right up against the tenets of this tax bill. So I can kick this horse as much as you want. I'm sure you get my point. And if you really would like, I did draft up a little white paper for Representative Stivar and Representative Locke, and gave them kind of a little more nuance to this problem. And you can always go back and listen to the testimony I presented to the House Revenue if that's something that you're permitted to do. But in any event, the bill has more problems than you want to hear about. I'm just talking about the constitutional stuff. Director Henson, I can't even imagine trying to put the existing tax valuation system through the valuation system we have and try to reconcile that with an acquisition cost and then try to figure out how to do it and backdate it back 4 or 5 years. That's beyond complicated. And I guess that would raise a whole nother set of challenges for our assessors and the department. But with that, I'll stand for questions. Again, I apologize for being overly forward with my testimony. I think it's important that you all realize how you're really pivoting to an entirely different methodology that the Constitution does not foresee. And if you really want to do that, as the report, the study indicated, you would absolutely have to amend the Constitution. There's no doubt in my mind that that would be required before you would undertake something on this scale. Thank you.
Questions or comments?
Other than that, he thinks the bill's great.
I want to push back a little. We say that everything's good and hunky-dory here in the current system. And if it was, there wouldn't be a homeowner who's going through an appeal and now getting ready to go to court because when his LEA was set up, he's on rural property and 2 of the properties in his LEA were on a golf course, and the 4 properties that were similar to his weren't in his own LEA. But that's okay, it's constitutional. So that's why we're searching for some reform to this. And we may not get it right, but we're going to keep searching. Thank you. Okay, who's next?
Mr. Chairman, members of the committee, thank you for allowing me to testify today. Dixie Huxtable, Converse County Assessor. I'm not going to go over a lot of the stuff that's already been talked about because you've heard it enough, the constitutionality, the issues that Director Henson brought forth. And historically, as county assessors, tax policy is not something we take a position on. We tell you whether we can administer it or not. So I'm going to focus on that to start with this discussion. And it ties primarily to the implementing of this bill, if it were to pass. The study that she mentioned in 2023 is the basis of what I'm trying to get to, is that study was to determine the options for implementing an acquisition value system. They found a lot of concerns, and Director Henson brought them to light for you and provided you with that study. And a lot of it had to do with infrastructure within the statutes that need fixed. And this bill does not do any fixing for most of those issues for us to administer. Starting with a computer valuation program, Director Henson mentioned it briefly. That's their responsibility to direct, but it cannot currently do this. So they would have some significant changes to do it. I want to talk a little bit about the mandatory sales price disclosure. You'll find that is one of the issues they raised in that study. As was stated, this bill is not intended to do away with our non-disclosure status. However, I would argue that if it's implemented by the year 2026, that disclosure sort of goes out the window, because starting with 2026, if I know you sold your property, I go look at what the assessor valued it at, and I know what you paid for your property. So over time, I do think this would erode that disclosure that they're trying to keep or not keep, or however it works down the line. They do change the statutes on page 3 of the bill. Currently, we use those statements of consideration, those sworn statements, in our analysis, and that's what the statutes say. We use them for our analysis, setting value. The change in the statutes based on this bill changes it that we shall use that value as the ongoing value in the future. One of the big problems we have with that, Director Hinson already spoke about, we get those statement of considerations with a value. It will contain a value that includes the house, the land, the outbuildings, the agricultural land, maybe even a tractor or a truck that went with the property. So if that's the value we're supposed to use, there's going to have to be some significant changes to the statement of consideration process for us to be able to use that and apply the appropriate acquisition value to the appropriate pieces of property. The biggest issue we have with it is the agricultural land, to be honest, because as you know, agricultural land is not valued at market value. And yet that fair market value, as you're determining it by the acquisition, is a fair market value. How do we allocate that? Do we take that property value that's listed on that statement of consideration and somehow try to come up with an allocation of what we're going to say is land, residential versus agricultural versus house? That is a significant problem. That's going to take some reconstruction of this whole reporting process. And so presuming that we do get that all cleaned up and we change the statement of consideration, I'm just here to tell you that we do not get those statement of considerations completed. Current law requires that with the deed, those statement of considerations be filed with the county clerk. And there are certain pieces of data on that form that have to be completed. It's not the clerk's job to verify that information. According to State Board of Equalization rules, that's my job as an assessor. I am continually getting a response when I call those people on that statement of consideration to verify that that is actually an arm's length transaction, that the information is correct. They're telling me that their realtor has told them they don't have to talk to me. So it's already a problem that we're dealing with now, and we're only using that statement of consideration information in our analysis. I can't imagine how difficult it will be to get that information when they know that what they put on that form is now going to set their value for future years. I really think there's a problem that needs to be vetted out before we go that direction, at least for the administration of it. Another part of it is the change in how the property was based on the 2019 base value, whichever year you chose to go to the base value. Properties are not the same. They change. There might have been a combination. There might have been a split. We've added new buildings. We've tore down old buildings. That account may not have even been in existence in 2019, but it was not acquired in between. It was just combined from two accounts put into one. Now we're trying to figure out which value do you want me to go back and use as the baseline. There's not a lot of good direction here on how we're going to do that. The sales, Director Hinson talked a little bit about the sales. I did a statewide analysis with all of our county assessors, and it works out in the last 5 years between 3.3 and 5% of the properties sold. You could imagine that the 5% was in that year when everybody was selling property, and then it's dropped back down to about 3.3. So theoretically, we're going to have a value to put on those properties, assuming it's arm length, assuming it's valid, assuming we can determine how to allocate that price. The other 97% of those properties need to have a value, and we need to have clear direction on how we're going to value those. And I provided a handout to you. It is a spreadsheet. I'll just walk you through it a little bit. The columns that are in green, that is the actual value of these properties. And you will see page 2 and 3 of your handout is a picture of the two properties I'm talking about. All the particulars have been redacted, so we've preserved the identification of where this property is, but they're two identical properties. The difference in these two properties is 100 square feet of concrete on the back and a little shed. These are very identical properties. That's the two properties that are in this chart. The first improvement sold prior to 2019. The second property sold in 2019. what I tried to identify with this chart in the green column is the value that I have on these properties. As if we continued in the current system, excuse me, that's how we valued them under the current system. The orange colored column is trying to interpret this bill using an acquisition value moving forward. And I'll be honest, I don't think I got it right. I had conversation with the bringer of the bill before this meeting started, and I think he confirmed with me that I didn't really get this exactly right. I understood that the intent, and the assessors understood the intent, that we were going to go back to a base year of 2019. And if the property sold prior to that, that's the base value we're going to use, and we're going to add 2%. That's what you will see reflected in that orange column on both the properties. The other piece that I think we got confused on, or maybe it's just me, the phase 2 portion of this, a property that sells in between that window of 2019 and 2025. My understanding is we're going to go to that acquisition value or some form of that acquisition value to move forward. I don't believe that's the case in this bill. I think this bill is still going to go back to a pre-acquisition value and move forward. And the reason I say that is the language in this bill on page 11 talks about how they're going to deal with the base value for those properties that sold. So starting on line 12, talking about properties that sold after January 1st and before December 31st of 2025. And it talks about the base value for the residential real property shall be equal to the fair market value of the property on January 1st of the year the property was last acquired. We value property on January 1st, as Director Hinson said, and we use the sales from the prior year to establish that value. So based on this language, that acquisition value never got impugned into this value at all, because you're using it on January 1st, the property sold on September 19th. Realistically, if you want to try to use that acquisition value in here, you might say that the fair market value of the property on January 1st of the year immediately preceding the year. That would be the value that we came up that closely resembles the fair market value using the system we do now. That would make the most sense, and truthfully on that chart, that's what I tried to do. But the bottom line on this chart is if you go through this and you look at the highlighted in yellow, that's that acquisition value where we took the beginning and added 2%, and you end up at the out on 2025, you end up with a value of $213,833 on that first one. The second property that you just saw is identical, and throughout history you can see we valued them very similar with less than $1,500 difference. That value is now $181,723 because of the way that we've phased in this process. It's not uniform. That's a concern for the assessors. We take an oath as elected official to uphold the Constitution. We feel that this bill would make us go against that oath as it is right now. We're not going to be doing things uniformly. And with that, I would stand for any questions. I know there's other people that may want to speak.
Would you agree that increase in taxes when there's a major addition or an outbuilding is collecting taxes on unrealized gains?
Mr. Chairman, I'm not sure I fully understand that question, because if I'm valuing those additions based on their cost, then no, I don't believe it's unrealized gain. That's the value of the property, and that's what I'm charged to assess as of January 1st. So when we are adding new additions or we're adding new buildings to that property that was in a certain condition in 2019, if we're using cost or whatever appropriate method that you want to deem, I don't see that as unrealized any more so than valuing anybody's property that hasn't sold. I still have to sell, I have to value everybody's property that hasn't sold. Those are all got, if your opinion holds true, then all the properties are that, not just the ones that sold or unsold.
That's where I'm headed with this. It's an unrealized gain. I've spent money, my property's now worth more money, and I'm paying taxes on that before I've sold it. where I'm headed with this is that is also unconstitutional in our state constitution. So it appears to me, once again, just opinions, we like the Constitution when we like it, and we don't like it when we don't like it. But if you assign a larger value to something I own that I haven't sold and realized the gain on that, that's unrealized. It's hanging out there. Thank you, Mrs. Huxtable.
Mr. Chairman, my job is to value it at fair market value, and I'm using appraisal methodology to get there. And if you want to define unrealized gains differently using the Constitution, that is certainly your prerogative as a policy decision in this legislature. But my job is to be at fair market value, and based on the definitions of fair market value, that is what your property is worth, given a knowing buyer and a knowing seller being knowledgeable and willing to sell that. And I'm following the appraisals methodologies that I am charged to follow. And so that's what I'm at. I'm not looking at realized gains or unrealized gains. I'm looking at what is your property worth on the as a fair market value on the open market.
And I apologize if you thought I was beating you up with that question. I really wasn't. In my mind, in tax law, I could buy a house for $200,000 and the valuation could go up, oh, I don't know, let's say 74.8% in 5 years. And I'm paying taxes on that increase. And then if the real estate market drops and I can only sell it for $240, I've been taxed for $274 for those 5 years or whatever, for an example. That's why I believe it's an unrealized gain. Thank you.
Chairman, and thank you for offering that concept and that opinion. I'm just saying that currently, based on the statutes and the Constitution that I'm prescribed to follow and the legal bounds that case law has provided, that's where I'm at. If you want to change the policy and change the definition, certainly that's within this legislative body. What I'm saying is if this is how you want to change it, with the language that's here, I can't administer it. You're going to have to put some more structure into the statutes to help me administer it.
Well, thank you. I appreciate that. Do we have anybody else that wants to speak on this?
Gail Simmons, Sheridan County, Civics 307 and Y vote, although that doesn't particularly apply in this case. I'm on and against this. I don't know anything about capital gains and how you do that on property versus investments. However, I want to point out that there are a range of definitions for critical thinking, including the process of analyzing available facts, evidence, observations, and arguments, Mr. Chairman, to make sound conclusions or informed choices. This precludes dismissing study results solely because you don't like the conclusions reached on the research conducted. An appropriate challenge would be to identify inaccuracies in the facts or the incompleteness of the study. None of that has been provided. Specifically, I'm referring to the acquisition value study approved and funded by HB 0100 in the 2023 legislative session. The results were provided to the Joint Revenue Committee in October 2023. These are readily available for anyone to peruse, so I will not cover. Those are in the meeting materials, numbers 201, 202, and 203. After having that discussion, LSO drafted bills from the October meeting for the November one. Those again are provided in the meeting materials from that November meeting with the required constitutional amendment specifically addressing Article 15, Section 11, uniformity of assessment required. In effect, for ignoring all the other things that have been provided here, this bill should not go into effect until passage of a constitutional amendment at a general election by the electorate. I urge you to vote no on this bill. Do not California our Wyoming. And I stand for questions.
I have a copy of that acquisition value study, and I was at the committee meeting when he covered it. And I asked him a very pointed question. Did you use Zillow in this report? He said no. Look at page 12 and 13 where it references Zillow. So I have a hard time putting a lot of weight behind that study when I'm imagining these two guys behind a computer using Zillow just to get paid and come up with a report. So I would agree with you. There are some unknown facts out there, but let's not fall back on that study. Thank you.
Mr. Chairman, I would simply state that that may be one section of it. But for example, the fact that California is the only one who's done this, Idaho tried, and after being completely unsuccessful in implementing it, they gave up. I think that that is probably a very relevant piece of information. Anyway, thank you very much.
That's definitely better than the Zillow study. Thank you. Please state your name.
Mr. Chairman, Committee, Mark Jennings, for myself, having run this bill about 3 or 4 times.
Well, welcome to the committee, former Representative Mark Jennings.
Thank you, Mr. Chairman and committee. I just want to touch on a couple of things. I know your time is valuable. Having to do with the study, because I was the one that ran the bill and then turned it into a study bill. The committee went with that. But I would point out a couple of other flaws. You already pointed out one very serious one, and that is that in that entire study, one, it went to a former assessor. I was one of the people. So there was a little, I would say, some prejudice to that. Number 2 was in that entire study, nowhere will you find a definition of acquisition. I find that if you're going to study something, it seems to me like that would be a fairly important thing that you'd want to know. And then I would point out a couple of other little things for you to look at. I've noticed that all the people that the refugees from California that have come here, I have not found one. I found one on the legislature, on the House of Representatives, who claimed that he hated it. And of all the people that have moved here, they like this. They've not been able to get rid of it. The people that dislike this idea, this concept, is almost always liberal politicians and bureaucrats that are served by a system that can be manipulated. I heard that very testimony, I think it was yesterday, on the floor in the House. Well, we're seeing a rise in the land valuations. If that's true, that makes this very much important. It shows a flaw in the system that's there now. And I think we're here because there's a flaw in the system now. I heard Mr. Hartzog say, well, we did this from the beginning of the Constitution, the founding. Really? Then what did we do in 1988? Was one side constitutional and the other wasn't? We didn't have to change the Constitution. They made a change in that. But the difference is for the people. They didn't realize that they were voting for being taxed on an unrealized capital gains. If that value goes down and we go to a depression, you made the point very well, Mr. Chairman. You know, you can be taxed on 275 and maybe you'll only get 75. And so all those years, the government received the money. I have an 80-some-year-old lady lives next to me. She went back to work, waiting tables because her taxes had gone up and she's going to lose her house. This is about the people. And everything that you've heard up here has been from the bureaucracy. I don't want to denigrate them. The director and I have fought over this for 4 years. And I think it's very clear that they are very resistant to this idea. The people are not. When some of the people that I work around generated around 11,000 emails. It was unfortunate that most of them didn't get to you. They went to your trash or your spam. The people are looking for some reform. They are not just looking for a Band-Aid in relief. And I think there are some things that you could do. I think you could put some trigger amendments in there that if this is implemented, some of the relief bills could possibly be removed. They should be repealed. This is the actual reform. Relief is some of these other bills that we've looked at. So with that, I'd stand for any questions, Mr. Chairman.
Questions? Thank you. Do we have anyone else? We have one more online.
No, that person left the Zoom.
Okay, with that, we will close public testimony. I think we'll finish working the bill on Monday, so we can get back upstairs now and not be too late. Does everybody agree with that? So we will reopen this up on Monday. We'll work the bill and do the vote then. And thank you all for coming to the Revenue Committee. We always have such fun topics. Have a good day.